thanks for tuning in to Infinium Investment Advisors December 2011 Market Update. I'm Mark Starosciak, Managing Partner of Infinium, and we wanted to just jump right in to this month's update, cover a few things with you, and that is taking a look at the markets relative to other difficult times or other bear markets around the world, and then more specifically the U.S. It's very insightful from our perspective to put our hands around, try to get our hands around this period of time, get some parameters for it, because it seems like it just doesn't go anywhere, yet it acts like a bucking bronco, particularly this year. And then as you look at the markets, really not quite as bad overall this year as one might believe. And then we want to pose a question, how is it that you manage money or manage your portfolio through these tough times? And we think we've got an answer for that. So we want to jump right into the presentation here. Obviously, anything we talk about is purely for informational purposes, not a recommendation to you to follow any strategy, buy any securities, etc. So jumping right in, make this a little smaller. We can look at other bear markets that have occurred throughout history, not only in the U.S. but around the world. And when you start to analyze them, you see some similarities amongst them. And so when you compare these difficult times in the market to what we're going through right now, it's really not that different, frankly. And so we can use these other periods of time as a gauge to sort of get our arms around this period of time, and then obviously develop strategies to combat the negatives and opportunistically look to profit. So no shortage of other examples by which to look at. And so what you see are some trends develop, and that is the first downturn is approximately 56% down on average, lasting nearly 3 years or 29 months. The second phase is a rebound generally in the 70% range, lasting on average 17 months, followed by another correction about half of that first downturn that you saw, lasting around a year. And then you go into this period here of a wide trading range, or what we call a consolidation period. That can last on average 5, almost 6 years. And the trading range can be quite large, 52%. If you were to look at the markets this year from the peak to the trough, again, just this year in 2011, we've seen a 20% swing. We were up 20% from the low, down about 20%. And right now, as you look at the markets, we're pretty much flat. Now, today is December 13th, Tuesday. The markets did sell off a bit with some news out of the Fed, basically keeping interest rates the same. And that's caused the market to drop. But nonetheless, we're within a few percentage points of being flat for the year. So although a roller coaster ride during the year, it's really the volatility that we believe has spooked investors. You look at your portfolios, generally they're near flat. So by no means a wipeout. So where do we stand today? Looking at the S&P 500 index, you had a 57% drop versus an average of 56, 80% rally versus 70. That first correction we saw back in 2010 was about 17% versus 25 on average. And then from a trading range perspective, if you believe this graph, when we entered it, the bottom was about 1022. We closed today around 1230 or so, somewhere in that range on the S&P. We've been in about a 33% range. On average, it's a 52% range. So if you think what we've seen this year is volatility, we may very well be in for a lot more of it. So obviously, you want to position a portfolio, or at least begin to think about your own investments. And do you have the proper structure for this type of market if indeed it plays out like other difficult periods? Certainly no guarantee of that. And so when you compare the U.S. to other bear markets here in the United States over the years, starting with 1929, going to the oil embargo in 73, and then of course the tech bubble bursting, you had many people back just a couple years ago saying how similar this was in 1929, not even close. I mean, you had an 86% drop there from peak to trough. We've been down 57. So nowhere near the order of magnitude of 1929. And you can just look at the shape of the markets here and the shape of these other downdrafts, looking pretty similar. So we don't necessarily believe that this is some a crazy period that we've never seen before. Certainly in our lifetimes, maybe, excluding 73, but this is not very abnormal for difficult periods, one that you may consider a bear market. So the question is then, how do you manage your money through this? And our answer to that is quite simply, you need a plan of action. It's just shocking to us how many successful or affluent individuals or families have not taken the time to craft a financial plan. And this is not an easy process, and there are obviously many other things we'd all like to be doing. But if you don't have a plan of action, it's very easy to let what's going on spook you and trick you into making a bad decision. So it's amazing when you have a well-constructed financial plan under your belt, the ability to sleep better at night and have more certainty about what your money needs to do for you and what you need to do from a savings perspective, it is well worth the effort. Trust me on that. So the questions that you need to answer are, indeed, what rate of return do you need to hit your financial bogeys? Many investors just simply don't know. And what we find oftentimes is whatever that number is, when you put all the data together, they're either way underinvested or not taking enough risk where they'll never hit their financial goals, or they might be taking too much risk and they could scale that back and sleep better at night, again, see a lot less volatility. And then on your side of the ledger, on the client side of the ledger, how much savings do you need to do before you reach that distribution phase? And that's really sort of our big turning point where you're distributing from your portfolios rather than contributing to them. And so what level of savings do you need every single year? It's absolutely crucial. If you put these two together, you now have a degree of certainty around your situation to help you get through these volatile periods. And then, we would just close with, have you taken the time to craft your financial plan? In our experience, within anywhere from 1 to 3 hours, total commitment from a client, we can come to the table typically with a very well constructed, well thought out, and insightful financial plan for them. So again, we would encourage you as we enter into 2012, if you have not taken time to do this, sit down with your financial advisor, give Infinium a call. We'd be glad to walk you through our process and see if it makes sense to you. But with that, hang in there. It's been a tough 2011, and with any luck, 2012 will treat us a bit better. And we look forward to seeing you next year.